If you've ever considered infinite banking but shrugged it off because you think you're too old, this episode is for you. We're going to review why age might not matter as much as you think and how you can keep more of your hard-earned dollars working for you regardless of your age. Be sure to stick around until the end and we'll discuss some bonus options in case you are not insurable or you really are quote unquote too old. Hey, if you're new here, my name is Kristyn. I'm an authorized infinite banking practitioner. I help Canadian families and business owners reclaim control over their money, create financial peace, and live the abundant lives that they were meant to live by keeping more of their hard-earned dollars working for them. So a lot of people think that they are too old for infinite banking to be worth it. I hear this from people that are in their 40s, 50s, 60s, even beyond. So in order to really break this down, I want you to think about a couple things. When we're talking about infinite banking, we are not talking about insurance. Yes, insurance is the product that we use, but it's not the be-all, end-all. And the purpose of infinite banking is to keep more of your money within your control and working for you. So let me ask you this. At what age do you stop having a need for money? Sounds simple, right? At what age does cash stop flowing through your hands rather than into it? And at what age does your bank stop accepting your deposits? The answer, of course, is never. All of these things keep happening as long as you're alive. And so that's why it's important that we start looking at infinite banking as the process and not as much about the product that we use. However, when we're talking about the product, we are talking about life insurance, and that's what tends to put a lot of people off. So I want to dive into that a little bit more. So a lot of people think, one, they're too old, or two, that insurance is too expensive once you get older. The truth is, your dollars cannot buy the same amount of death benefit as they could have when you were 20. That's absolutely true. As a 20-year-old, you're going to be a lot more efficient. Your dollars are going to work harder simply because you have a longer runway. You have a lot more years that you are going to pay into this for that same death benefit in the end. However, when we're talking about designing policies for infinite banking purposes, we're not designing these primarily on a death benefit. The idea is that we want more liquid cash to be available to you, and we want it working for you in the background. So while the death benefit is important, it is a bonus and not the be-all, end-all and why we are doing these policies. Now, the purpose of infinite banking is to become your own banker. You want to keep control over more of your cash, and you want to keep it safe from the CRA and from big banks and from high interest debts that can accumulate. Now, I would argue that it's even more important to take control over your money in your golden years. You've worked hard for your savings and you want to keep it safe. You want to keep it protected from market crashes, and you definitely don't want to leave more to the CRA than you do to your own family. So the problem isn't that you have savings. The problem is where your savings are residing. We have to trade off between either the risk for a higher return. So either you have really high volatility and you're risking losing cash in order to make a return, or you have to compromise and accept a really low return. Think of things like your GICs or a fixed income portfolio that are relatively safe, but the amount that you're making on these investments isn't enough to keep up with inflation. Then we have to look at tax liability for your family when you're gone. What about your capital gains? What are they going to be charged tax on? Capital gains on even non-registered investments. You have probate. In Ontario, that's 1.5% of all of your assets. And we have, if you have RRSPs, those are taxed as income on your final tax return. Meaning, if you have $1 million in RRSPs, guess what? When you pass away, if you have a spouse, they'll roll over to your spouse first. When that second spouse passes away and you expect all of that cash to go to your children, half of it is going to go to the CRA because now your income for that year is that $1 million. So we want to start thinking very strategically, especially in these golden years, about what we are doing with our cash flow and where we're moving our money to and from. One way we can do this is very strategically melt down investments. You want to spread the tax liability over several years and move funds from those higher taxed liabilities. So things like your RRSPs, we want to make sure that we're melting those down first. whether that's through your income that you need to live on, or if it's just strategically moving it into something like an insurance policy so that you can still remain in control, keep access to it. You can start pulling it out to supplement your retirement income if you need to. There's a lot of ways that we can keep that cash accessible to you so that you still are able to use it during your lifetime while keeping it under that tax-free umbrella and keeping it out of the hands of the CRA. So when we're melting down your investments, we want to look at what the tax liability is, not just today, but what the tax liability will be down the road. We want to start looking at this when you're in your 50s, 60s. One problem that I see a lot of people having, my clients, I have a lot of business owner clients, and they're starting these businesses when they're in their late 40s, 50s, so that when they hit those retirement years that they expected to not be working and not having an income, they all of a sudden have this business income that is creating a tax liability for them. The problem is they saved their whole lives just like they were taught into RRSPs. And as we know, once you hit a certain age, you have to start pulling RRSPs. When that happens, those are added to your income, to your taxable income. So now you have to pull more RRSPs to cover the tax liability for one, but also even if you don't need that cash, you still have to pull it as part of that contract with your RRSPs. Once they turn into a RRIF, you have a certain percentage that you have to draw down. So we have a couple problems there. How would melting down those RRSPs help? Well, when you have lower income business years, those are the years that you want to pull more RRSPs out. It's better to take a tax hit on some money over the course of a decade than it is to take one big lump sum and move it into something else. You might also want to consider moving RRSPs into non-registered investments if you have the risk appetite that you still want to be putting things into riskier funds. That's something that you might want to look at doing. So all of that said, when we start talking about the infinite banking concept, let's loop back. We want to keep your cash working for you. So when you're putting your cash, whether you're moving it from your income, whether you're moving it from, I have clients that just take their CPP or their OAS and they put that into life insurance policies because they don't need access to that cash right away. Then we are keeping you in control of that cash. We're stopping the tax liability. It's under that tax umbrella, the tax-free umbrella of insurance. And you get the peace of mind of knowing that it's going to grow safe from market fluctuations. You know that your cash value, the amount that you can borrow, has to equal your death benefit by the age of 100, has to happen. We know that your death benefit has to pay out. That's a guaranteed. What that will do is give you permission to spend your savings. We all want to leave a legacy for our children and grandchildren when we're gone. But this frees you up so that you can spend the savings that you have while still knowing that they're going to get a death benefit tax-free later on. We can also use that death benefit, again, strategically for your taxes. We want to make sure that we have your tax liability covered. So on your final tax return, if you know that you're going to owe $500,000 in taxes, we want to make sure that we have a death benefit that's appropriate to be able to cover that tax liability so that your kids can keep things like your family cottage without having to sell other assets to be able to keep that in the family. So when we start talking about the infinite banking concept, a lot of people wonder if it's worth it for them to do because they don't have a need for finance. And honestly, I would argue that yes, you do. You're financing everything you buy. Either you are paying interest to someone else, like when you do something like a car loan, or you're giving up the interest that you could have earned otherwise by when you're paying cash. So when we're talking about retirement, people are often pulling from their registered accounts or their TFSA to make these bigger purchases. Let's say that you are retired and you need a new car. It's better you don't want to pay interest to someone else, so you're going to just pull that $50,000 from your TFSA, pay for the car. But guess what? That money is gone forever. The car's not going to last the rest of your life in all likelihood. You've now lost all of that ability to be able to earn on that income every year going forward for the rest of your life. So when we start talking about the infinite banking concept, the idea is to have your savings inside of your life insurance policy. Then you borrow against that to finance the things that you need. You keep the cash growing that you have put into that policy. It's going to grow for the rest of your life. Then you pay back that loan just like you would have to an outside bank loan. The result, more cash is captured into your hands and going to go to your family rather than your bank down the street. Again, I hear a lot of people, I can read your mind, I can hear you saying that, but I don't need to buy things. I don't need to make big purchases like that. Okay, let's talk about a family bank. What about your children? What about your grandchildren? Could you help out your child or grandchild by being the family bank for them? How much would it have improved your life, or how much would it have made your life much easier when you were younger if you could have bought a car and paid back a loan to your grandparents rather than to the bank, right? Every dollar of interest, and you want to charge your kids interest. You want to charge your grandkids interest just like they would have paid to the bank. Why? Because every dollar of interest that they are paying is money going back into your family bank, your system, that is going to eventually come back to them in the form of a tax-free death benefit. You're starting this generational wealth, you're starting this bank, and most importantly, you are starting this financial independence and the mindset of knowing that you have this structure inside of your family, and it's giving you that control and that freedom to be able to operate outside of the traditional banking system. That means you don't have to worry about credit scores, you don't have to worry about credit checks, you don't have to worry about a debt ratio. What if you could have borrowed your down payment for your first home? There's so many ways that we can use this. Even if you as the parent or grandparent, even if you are not using your policy, I want you to start thinking about ways that you can start using your system of policies as a family bank for your kids, for your grandkids, and how you can help them, not by giving them money, not by doing them favors, not by even making the cost of borrowing cheaper. I'm talking simply about restructuring their lives so that they're going to pay into their family bank instead of the bank down the street. It's going to create more and more and more inside your family bank. Now, I want to talk about math for a second, because a lot of people, going back to that, I can't afford it, it's too expensive at my age. I want to talk for a second just to kind of compare what it could look like if you're looking at this as a 65-year-old, let's say, because I know that my presentations, I often use a 35-year-old as an example. So in both cases, I'm going to use a man. The reason is men are more expensive to insure than women because they tend to pass away sooner. So let's just say you've paid $12,000. If you've been around a bit, you've seen my presentation where I show this $12,000 a year that a 35-year-old is putting in, and we see how much it accumulates over the course of his lifetime. Let's just look at that over 35 years. So as a 35-year-old, after 5 years of putting in $12,000, assuming the current dividend scale stays the same, you would have a cash value of about $60,000. As a 65-year-old, again, man, putting in the same premiums, so $12,000 a year, his cash value would be about $57,000. The difference is about $3,000. There's not that big of a difference when we're talking about using this for a banking system. Your banking system still has roughly the same balance. Death benefit, of course, the 35-year-old, that same amount going into a policy, their death benefit will be about $430,000 versus a 65-year-old at the same point of 5 years will have about $171,000 in death benefit. Of course, your dollars are not going to go as far because you're not going to pay into it as long as that 35-year-old. Think about it. If you're buying a car and you're going to pay for it over 2 years, you're going to pay a lot more for that car on a monthly basis than someone who spreads it out over 7 years. That's just math. Let's just fast forward to year 30. So 30 years in, our 65-year-old is now 95. Our 35-year-old is 65 now. Again, putting that $12,000 a year in, he's going to have a cash value of $800,000. That is what he can use as his family banking system. That's what he can leverage. Our 65-year-old, who is now 95 years old, 30 years later, he has $615,000 available that he can be using inside of that same family banking system. The death benefit at that point for our 35-year-old is quite a bit higher, of course, about $1.5 million. Where our 65-year-old that is now 95, his death benefit has grown to about $680,000. So again, your dollars are not going to buy as much death benefit over time. However, what I hope that you got from this is that your cash value is what we're looking for. We want that banking system. We want cash to be accessible to you that your family can be using over and over and over and over again. Now, this is where it's really important to discuss with your advisor what your goals are. Because if you're looking to just pass on cash when you pass away, if you are a lot more interested in having this tax-free death benefit that's passed on to your family, you're not going to need to use this cash, especially for the first, 10, 15 years, then we can design the policy accordingly. We can put the focus more on building more death benefit instead of having early access to cash value. So we can always do a mix of things. There's always different ways that we can design these policies to be able to customize it according to your needs. Another option that we can use if there are two spouses, and it's especially helpful if there's a big age gap, so if one spouse is much older, or if they're in poor health, we can actually do a combined policy. So we can have a policy that pays out when the second spouse passes away. This lets you combine your insurance ages. And just to kind of give an idea of what that looks like, if you were both 65 years old, your combined insurance age would be more like 55, 56 years old, depending on the carrier, meaning that you would get the same rates as someone almost a decade younger. So you get a lot more bang for your buck. It's going to increase the death benefit. It's going to help increase your cash value, help make your dollars work even harder for you. Of course, the downside is that you wouldn't get this payout when the first spouse passes away. So this is something that, again, we have to custom tailor to you and your needs and make it work for you. So again, why would people want to use that cash surrender value? You want to use it as your family banking system. If you don't have a need for it, if you don't have a desire to invest in other things and make those dollars go out and make friends, you can invest it, I'll say in air quotes, by lending it out to your family, lend it out to your kids, your grandkids. You want to have a structure in place. You want to make sure that you have a repayment structure so that you know that, so that they know that they're going to pay you back, how much they're going to pay you back. The advantage to this is that every dollar they pay back is going to go back into their family banking system, and it's going to increase what comes back to them eventually in the end. This allows you to help out your kids now while maybe they need it. It helps you to see your legacy instead of waiting until you're gone, and then your kids can expect this windfall of an inheritance, and they're going to use that to go on a vacation or to start a business. You get to actually see the fruit of your labor, of your lifetime. You get to see your legacy in action while you're still alive. Eventually, what will happen if there's outstanding policy loans when you do pass away, those will get paid first, and the remaining death benefit will go to your beneficiaries, so your kids, grandkids, whoever you name, tax-free. Now, I promise to go over what we can do if you're not insurable. This is actually really easy because we can insure someone else. If you're not insurable, if you're in poor health, if you have other issues going on, or if you truly are too old, which the age limits vary by carrier, but generally it's into your 80s. If you truly are too old to qualify for life insurance or you're not insurable, then we can insure a loved one. You can insure kids, your spouse, of course. You could insure your grandkids, in-laws, really anyone that you have a relationship with, even business partners. Use the policy in the same way. You would be the payer. You are going to be the owner of the policy, and we would just set up a successor owner, so someone who would take over the policy once you pass. That's a strategy that we really want to make sure that the other person, the insured, of course, is aware of what's happening, because if they're going to take over this policy, you want them to be aware of the costs that might happen, or what the policy will be worth if they choose to surrender it once it's passed to them. I wouldn't recommend it, but again, it's an option that they have. We can also set up like a one-time deposit into something like an annuity so that you can keep paying for that policy over the course of 5, 10, 15 years until it's fully paid up. You can also have dividends, takeover payments. So there's a lot of different options that help you to keep your family banking system moving, even if you have to insure someone else, and even if that policy is going to outlive you as the policy owner. There's a lot of ways that we can do this. So I hope this has given some insight into why age doesn't matter quite as much when we're talking about implementing the infinite banking concept, and that we can use this really regardless of your age and your health. There's just different strategies that we can use. I hope you found this episode helpful. Please give it a like and hit subscribe. When you're ready to take the next step and see if infinite banking is a good fit for you, I encourage you to click the link in the description. You can access my free resources or book a call to see if it's a good fit. Until next time, live free.